You know when a file is too big for email, so someone sends you a WeTransfer link and says, just download it here? That tiny moment is the way into this IPO. Bending Spoons doesn't only own WeTransfer, but that file link shows the kind of familiar digital tool it likes to buy, fix, and run. The company is Bending Spoons S.p.A, a Milan-based software owner preparing to trade on NASDAQ under the ticker BSP, the short stock market nickname people use to find it. On the cursor stocks, the central question is simple. What would have to be true for this IPO to actually make sense? Bending Spoons is led by CEO Luca Ferrari, was founded in 2015, and is headquartered in Milan. The story matters because this isn't a brand new app asking you to believe in an idea. It's a company built around buying apps people already know, then trying to make those apps run better as one bigger machine. Think of Bending Spoons as a house for digital products. It owns or has agreed to buy names tied to notes, files, video, events, publishing, and old internet media. The hidden role is not that it invented every tool from scratch, it's trying to be the operator behind tools that already have users. Why does that business exist? Because many internet products become famous, then get messy, slow, or expensive to manage. Bending Spoons says its edge is people, technology, and proprietary data that help it rebuild products after acquisition. The bet is that one central team can improve many separate apps. The money engine is easier than it sounds. If you pay for more storage, a better note app, video tools, event software, or a professional plan, some of that payment can flow into this group. Revenue is the money coming in before expenses. Profit is what is left after the bills are paid. Now comes the IPO, the moment a private company starts selling pieces of itself on the stock market. Bending Spoons is set for July 1, 2026 on NASDAQ. The price range is $26 to $28. And because the expected raise and share count line up, the implied expected price is around $28 a share. A company goes public for a few reasons: raise money, give itself a bigger spotlight, and sometimes let early backers sell later. Here, the headline number is big. About $1.62 billion is expected to be raised, which is more than the company's latest full-year revenue, so investors are being asked to fund a very ambitious next chapter. Notice what's missing. The final valuation, the price tag investors are putting on the whole business, hasn't been set. That matters? If the file link is our everyday doorway, valuation is the question of how much Wall Street thinks the whole house of apps is worth, not just whether one app is useful. The growth story is why people will pay attention anyway. According to reporting, first quarter 2026 revenue was about $601 million, up from about $259 million a year earlier. That says the group has been getting much larger quickly, helped by acquisitions. The question is whether that growth is durable or just deal-driven. Bending Spoons has also been shopping aggressively. Recent reported deals include Brightcove, Eventbrite, Vimeo, and AOL, all recognizable internet names in different corners of the digital world. This is the part investors will argue about. Is this smart compounding, where each deal makes the platform stronger, or just a fast pileup of complexity? The bull case starts with something simple. These products already have names people recognize. You don't need to explain what a file transfer, note app, video host, or event page is. If Bending Spoons can improve pricing, design, speed, and reliability without pushing users away, it could turn familiar tools into stronger cash generators. The second bull point is focus. Instead of every acquired company keeping its own separate playbook, Bending Spoons wants one operating system across the group. Shared engineers, shared product habits, shared data, and a repeatable way to rebuild apps. If that works, the next acquisition could become easier than the last one. But here's the catch. This strategy can feel rough to users and employees when prices change, features move, or teams are cut. After the WeTransfer deal, reporting said the company planned to cut about 75% of staff there. That's 3 out of 4 jobs, and it shows the human cost behind the efficiency story. The latest full-year financial picture is unusual. Bending Spoons brought in about $1.31 billion of revenue, while net income was a tiny loss of about $137,000. So this isn't a company losing hundreds of millions in its latest full year, but it also isn't showing a huge profit cushion yet. Competition is not one clean enemy. The file link competes with cloud storage, note apps compete with office suites, video tools compete with meeting and hosting platforms, and event tools compete with ticketing marketplaces. If customers feel squeezed, they can often move. That's why user trust is not a soft issue. It's part of the business. Now return to the central question. What would have to be true for this IPO to make sense? The expected raise alone is about 1.2 times latest full-year revenue. Without a final IPO valuation, we can't judge the whole price tag yet, but we can say investors are funding a very large acquisition engine. Another thing to watch is who benefits from the offering. Shares are tiny ownership pieces of a company, and about 57.97 million are being offered here. In any IPO, new investors should check the final prospectus for how much money goes into the business, whether insiders are selling, and the lockup, the waiting period before early holders can usually sell. After it lists, watch 3 plain signals. First, do the acquired apps keep users instead of losing them? Second, does revenue grow without relying only on more acquisitions? Third, does profit improve after restructuring costs, debt costs, and product investment? Those answers matter more than the first-day stock pop. The balanced version is this. Bending Spoons could be a rare public company built to collect and improve useful internet tools. The doubt is that buying many brands, changing them fast, and keeping users happy is hard. So the IPO isn't just about a stock price. It's about whether this machine can keep earning trust. Circle back to that WeTransfer link. A tiny, everyday action led us into shares, revenue, profit, valuation, competition, and risk. That's how you read an IPO story. What it sells, who needs it, what could go right, and what could break. Follow the cursor stocks for the next one. This video is for information and education only, not financial advice.